Dr. Haugen, during your presentation just now, you said Bernanke should be fired. This is ridiculous. What were you referring to?
I was referring to QE1 and the expectation for QE2 and the fact that he's ordered it and it's happening right now. These explosions, and that's what they are, in the monetary base are going to be a disaster. You can pick which of the following three things are going to happen. They all spell a disaster. Number one, the banks continue to not loan money. That's a disaster. Number two, the banks decide to loan the money that is in the monetary base. That's a disaster because the money supply will rapidly increase. Inflation will rapidly increase. The value of the dollar will rapidly go down. Stock market will collapse. So that's a disaster. What else can happen? The Fed can walk it back. How are they going to walk it back? They're going to walk it back by selling bonds. Lots and lots of bonds. Problem is they're going to be selling bonds when the Treasury is also selling bonds. And they're going to swamp the bond market, driving interest rates way up. And that's a disaster. So no matter how you look at this, getting out of it is going to be a disaster. And Bernanke created it. He's responsible for it. So he should be fired.
There have always been doomsday scenarios out there. How likely is it that this time will be the one?
To see this, you have to see a graph of the U.S. monetary base throughout its history. You can go to the Federal Reserve Bank of St. Louis's website and print it out and take a look at it yourself. You'll see that this is unprecedented. This has never happened before. This is the doomsday scenario.
In your presentation, you mentioned that low risk, low volatile shares and bonds were the way to go because in the long run they earned the most.
You don't want to invest in bonds because interest rates are probably going to go way up in this scenario, whether it's driven by inflation or whether it's driven by the marketing activities of the Fed and the Treasury. Interest rates are heading up, so bond prices are heading down. You could invest in cash, and that's not a bad strategy, but the point is, for many institutions, most institutions, they just can't invest in cash. They've got to have the traditional exposure to equities, and I'm offering an alternative, low volatility equities, where they can get out of the market without really getting out, and also earn a premium return in the process.